Discontinuation decisions are important management accounting decisions that involve determining whether a product, service, department, customer segment, project, or business activity should be continued or discontinued. Within the program framework, these decisions require managers to evaluate the financial and operational consequences of eliminating an activity that appears unprofitable or strategically undesirable. Although discontinuation decisions are often triggered by poor financial performance, management must carefully assess both quantitative and qualitative factors before taking action. The objective is to improve overall organizational performance by ensuring that resources are allocated to activities that generate the greatest value and support long-term strategic objectives. The foundation of discontinuation analysis is the identification of relevant revenues and relevant costs. Managers must focus on the future revenues that will be lost if the activity is discontinued and the future costs that can be avoided as a result of the decision. Costs that remain unchanged regardless of the decision are irrelevant and should not influence the analysis. For example, fixed costs that continue after a product is discontinued may not be avoidable and therefore should not be treated as savings. Effective decision-making requires distinguishing between avoidable and unavoidable costs to determine the true financial impact of discontinuation. Contribution analysis plays a particularly important role in discontinuation decisions. A product or service that appears unprofitable when allocated overhead costs are included may still generate a positive contribution toward fixed costs. If the activity contributes more revenue than variable costs, eliminating it may actually reduce overall profitability because the contribution will be lost while many fixed costs remain. Consequently, management accountants often use marginal costing principles to assess whether an activity contributes positively to organizational performance. Decisions based solely on reported accounting profits may therefore be misleading and result in unfavorable outcomes. Opportunity costs should also be considered when evaluating discontinuation alternatives. Resources released through discontinuation may be redeployed to more profitable activities. For example, production capacity, labor hours, management time, or sales resources previously devoted to a discontinued product could be redirected toward products with higher contribution margins. In such cases, the additional contribution generated from alternative uses of resources becomes a relevant benefit of discontinuation. Considering opportunity costs enables managers to evaluate not only the direct consequences of discontinuation, but also the potential value created through improved resource allocation. Financial analysis alone is insufficient for effective discontinuation decisions. Managers must also consider qualitative and strategic factors that may influence long-term organizational success. A product with low profitability may support relationships with key customers, enhance brand reputation, provide access to important markets, or complement other profitable products. Similarly, discontinuing a service may affect employee morale, customer satisfaction, or competitive positioning. These factors may not be easily quantified but can have significant implications for future performance. Therefore, management should integrate both financial and non-financial considerations into the decision-making process. In conclusion, discontinuation decisions require careful evaluation of relevant revenues, relevant costs, contribution, opportunity costs, and strategic considerations. Management accountants focus on future costs and benefits that differ between continuing and discontinuing an activity while excluding irrelevant costs that will remain unchanged. Contribution analysis helps determine whether an activity adds value to the organization, while opportunity costs highlight alternative uses of released resources. Qualitative factors such as customer relationships, market presence, and strategic objectives further influence the final decision. By combining rigorous financial analysis with broader business considerations, organizations can make discontinuation decisions that improve profitability, efficiency, and long-term value creation.